Thanks very much, everybody. Good afternoon. We'd like to get started so that we can get you out on time, as it were. Hope you're enjoying the first day of the conference so far. My name's My-Linh, and I'll be your moderator this afternoon. I'm also going to be cheeky and sort of sneak in as a practitioner as well, because I'm also involved in this area and personally very interested in it. So I am head of ESG investment risk at BlueBay Asset Management. So my role is to try and integrate ESG issues into our investment process. We are a dedicated fixed income manager. We're involved in both the public and the private debt, and we invest in sovereigns and corporates. Prior to my time at BlueBay, I was actually in 2 multi-asset manager houses where I was part of an SRI and RI dedicated team. And my role there involved engaging with equity issuers actually on ESG issues. And the reason I'm talking about this is really to sort of set into context my journey. I've come from ESG in equities to ESG in fixed income, and it's been a really steep learning curve for me in terms of trying to get my head around this. So one of the issues that I'm constantly grappling with is the extent to which we have a case as debt investors to engage with issuers, and if we do have a case, how do we actually go about this to make it effective? So I'm really pleased to be here, and I'm very fortunate that the panel of speakers we've got today are sort of grappling with these issues really, and so I'm really looking forward to hearing from them and getting their insights and sharing it with you so that we can actually motivate you to do more in this area. So maybe I'd like to introduce our panelists. Well, I'm going to go into the order that actually we've been listed here on here, so very convenient. So we've got at the far right there, Mariska. She's a senior credit manager and she works at MN. Then we've got James Fisher. He's our sort of, I think, non-sort of investor representative, but very, very welcomed here. He's from the legal firm Reed Smith, and he's a partner. Then we've got Alex next to James. Alex works at PIMCO, where he's the ESG portfolio manager. And last but not least, we've got Marayka. And she's a senior portfolio manager as well at QIC, as it were. In terms of how we'd like to run the session, in terms of scope, it's really very much that we would like to give you an insight into some of the dynamics and some of the nuances in terms of ESG and fixed income. We're not going to cover everything. It's a big topic and we've only got an hour, but we really want to sort of give you some of the tasters on that. And then I guess as well, in the interest of time, we very much positioned this session as engagement in the context of corporates rather than sovereigns, but I think some of you would have been around for this morning's session, which was focused on sovereigns, so hopefully that covered it off there, or we can cover it off in some of the questions. In terms of the format that we'd like to run this afternoon, it's very much in terms of a facilitated discussion. I've sneaked in questions that I personally want to know the answer to, so I can take back home on that side, and I think they're questions that you would be interested in as well. And then also we'll allow time for some questions at the end, about 10 minutes, so that you can put forward to the panel in terms of some of the points that they've raised or points that we haven't raised. And then lastly, we'd really like some interactivity and in terms of audience polls. We've got 3 planned. This morning it didn't go so well, so we'll have a go to see if the technology works. If it doesn't, we'll do by a show of hands, as it were. But maybe just to pick up on that in terms of practicalities to make that work is hopefully you've all had a chance to download the conference app. If you have, to find the polls, you just need to go to the agenda section of the app and find this session. And when you found this session, you scroll right down to the bottom. There's session, I think it's session engagement, and that's where the polls will be when we come to do those later on. And then maybe another point of housekeeping is just in terms of if you could make sure your mobile phones are on mute, that would be great. So with the sort of practicalities aside, I'd like to sort of make maybe a few points to set the scene in terms of why are we talking about ESG bondholder engagement, and in particular, why now? And to that, I guess I would just make a few comments and a few points, and that is, first of all, is that for us as debt investors, it's all about downside risk. Our upsides are capped, our downsides are unlimited. We've got nothing but to focus on capital preservation and downside risk management. And from what I can see, correct me if I'm wrong, the bulk of the academic evidence points to ESG being beneficial in terms of downside risk management. So for me, the two go hand in hand. Secondly, I think the debt market has a really, really important role in terms of facilitating the transition and in terms of creating a sustainable financial system, because the nature of the funding that we like fits very well in terms of the funding that's needed in the future, in terms of the stable cash flows, the operating predictability, and the yields that you're getting are more attractive to fixed income investors versus equities. And then another point I'd like to make is that, and we'll come on to that in the panel discussion, because I think it's such a barrier psychologically to people, is that people think we shouldn't be engaging because we're lenders, we're not owners. I'd really like to sort of unpick that a bit more, because I think it's so fundamental. But to really make the point that we do have influence, we do have rights, and we do have a responsibility, and it stems from a business case as well as a values case. And then lastly is, I think why now, is that the asset class is huge. We've done a lot on ESG and equities, but actually the fixed income market is a lot bigger. And it's getting to the stage where other investors and stakeholders are starting to put scrutiny, rightly so, onto us in terms of what we're doing on ESG. And I just think we need to be proactive and actually seize the agenda in terms of, instead of getting it being forced upon us and potentially have regulatory risk. So I think it's a call to action on that side in terms of us being proactive. So that's in terms of setting the scene. What I'd like to say is, following on from that, is that I think the PRI have been very insightful in terms of the timing of their work programme looking at ESG and bondholders. Is that in last year, in September 2016, they convened a group of investors to look at this area specifically in terms of bondholder engagement. So a working group was set up. There's 13 organisations who are members of that, of which 3 of us are on the table here, as it were. So Alex, Mariska and myself, we're on there, and we've been very busy. And one of the products of that is actually a discussion paper and some case studies that will be coming out in the early November, actually the 2nd of November. If you'd like to make a date for that, we're actually going to be hosting a webinar where the results of the paper will be published along with the case studies. So you'll be able to register for that as well as part of your registration for the conference as well. But I'll talk a bit more about that. So maybe before we start the panel, let's try and get a feel for who's in the room. In terms of the first of our 2 polls, is really to gauge who's in the room in terms of who are debt investors and what you're doing on ESG. Now, as I said, hopefully you've all been able to download the app. I'll just get a steer from the back. We can have a go on that. In terms of the first question that I've got listed on here, which, just make sure I read it. Okay, on there. So once you've clicked onto there, you're going to have about 20 to 30 seconds to submit your answers, and only one answers, please, if you can. I'll read out the question and then the options, and that will hopefully give you some time to select what you'd like to have. So the first one is, does your organisation currently engage on ESG issues as debt investors? So you've got an option of yes, we currently engage with debt issuers. No, but we're planning to engage with them. No, but we actually don't have any plans. And then we've got a catch-all, which is not applicable because we are not debt investors. So everybody have a go at doing a selection. We'll have wait. Yeah. Brilliant. Okay. Should we give you a few more seconds? Okay, brilliant. So I'll stop it there. Anna, do you think we'll have the results? Do I need to click it forward to? Suspense here. Okay, it's not working. Okay, no worries. So let's go back to manual and with a show of hands, maybe. So remember, you can only choose one option. So maybe I'll run through them. So put your hands up if you would answer yes, we're currently engaging with debt issuers. Oh, not bad. In the room, it's interesting. Remember, you can't vote for any other options. We'll be watching out where you're sitting. No, but we're planning to engage with debt issuers. And then no, but we actually don't have any plans for the foreseeable future to engage. Don't be shy, there's nothing to be ashamed of. Brilliant, okay. And then who do we have in the room that are not debt investors, so we can get a sense? Okay. Okay, well, might pick on some of you later on that one. So maybe moving on to our second poll. Okay, we haven't got it showing on there. Don't worry, I'll read out the question on the poll because we're not using the technology now. My second question is, what is the primary purpose of your engagement that you conduct? The options are 1, for insight, in terms of understanding ESG risks. Influence is your second option, in terms of asking issuers to manage a specific risk. and then lastly, not applicable again. So maybe if we sort of, for the first option, in terms of you engage primarily for insight, show of hands. Oh, interesting. Okay. And then in terms of engaging for an influence, that you're specifically trying to push an agenda. It's interesting. Okay, that's really helpful. That's great. So now we've got a sense for who's in the room. Let's try and find out a bit more about our panellists. So what I'd like to do before we start off with questions is really to give them each an opportunity. We'll start from the far right and move in if we can. Is that maybe they can spend a minute or so explaining to what extent their organisation has debt exposure, to what extent you address ESG issues within your organisation, how you approach engagement, and maybe what your role is within there. Maybe Mariska, could you start off?
Thank you, My-Linh. My name is Mariska Douwens, Senior Credit Manager at MN, a large Dutch pension fund administrator and asset manager. We have about 50 billion internally managed fixed income assets, so quite some exposure. And the way how we've ESG fully integrated within fixed income, and we also have a separate responsible investment and governance department, and have a lot of interaction between them.
As My-Linh pointed out, I'm the imposter in the room here, being a partner in a law firm, Reed Smith. Reed Smith's a global full-service law firm with 27 offices across the US, Europe, Asia, and the Middle East. I work in the structured finance team, and in that team, which is a globally capable team, we advise all types of market participants, including bond issuers, bond trustees, and bond investors throughout the life cycle of the issuance process. And we've been working with PRI to give some legal input to the discussion paper that My-Linh just referred to.
Brilliant. Thank you, James.
Hi everyone, I'm Alex Struc from PIMCO. PIMCO is primarily a bond house. We're 1.6 trillion under management, and we're 45 years old. Our aspirations, once we've took the world of bonds from clipping coupons to active trading and complicated derivatives, and our aspirations to do the same with sustainable finance. With respect to engagement, I head ESG portfolio management at PIMCO, working with a large group of professionals focusing on engagement and ESG integration. And I chair the Bondholder Engagement Committee at the PRI.
My name's Marayka Ward. I'm a member of the fixed income team at QIC. And within the fixed income team, all of our credit analysts are expected to have a view on the ESG practices of a company as part of their credit analysis of that company. QIC itself is a Queensland-based government-owned fund manager. We have around $80 billion under management, predominantly in unlisted assets. So we operate across the infrastructure, private equity and real estate space. Within the organisation, we have a central responsible investment team, and that team reports directly to the chief executive. And then within each of the asset teams, we've got ESG champions, such as myself, and we also have direct responsibilities for investments. So we believe that sort of model enforces you to think about ESG as part of your investment decision-making process.
Thank you very much, that's great. So hopefully you've got a bit more of a sense about who we are today. So let's kick off with maybe the questions. I guess my first one is very back to basics in terms of why are our panellists engaging in terms of ESG with their investments. So maybe I can start off with you, Mariska, in terms of what is your motivation at NN?
A vast majority of our fixed income portfolio is for Dutch pension and benefit members, and preserving value is key. It's part of the so-called matching portfolio. So it's all about risk there rather than upside potential, like with equities. So in order to understand those risks, in our view, company insights are a really critical input. So that requires not talking about companies, but also talking with companies. So that's the perspective we take within the MN.
Okay, thank you. So obviously, not surprisingly, I think we're looking at this from a risk perspective, but I wondered to what extent any of the other panellists have sort of another emerging motivation or something that is parallel to that. Maybe Alex, would you like to comment?
Yeah, sure. I think risk for us is also a primary objective, and for us it's macroeconomic trends or fundamental trends that are disruptive to companies but not always presented on a balance sheet today, which we have seen will be presented on a balance sheet tomorrow. But in addition to that, one area that excites us a lot and one area where the bondholders can make a difference in the area of impact. So we've done a decent amount of work on applying sustainable development goals and engaging with companies for the purpose of what they can give back, effectively social footprinting of the portfolio, in addition to that of identifying risks.
Okay, so we're seeing an emerging, I think, that was being reflected in the approaches that are becoming prominent in terms of positive impact investing coming on that. I guess as well from my side is that I think it's interesting when me coming from equities and turning to fixed income is that out in the market when I'm talking to investors and other stakeholders, there is the natural assumption that if we're equity investors, we should be actively engaging with issuers. But when it comes to fixed income, you haven't got that same assumption. And for me, it seems to be the primary reason for that is because people are attributing the fact that we're not owners, so we don't have any leverage, so there's no point in us engaging. So I really want to unpick that and see to what extent that's actually a valid assumption. And maybe to do that before I ask the ambassadors is maybe to pick up on James, because I think we're really fortunate in having his sort of legal perspective here with us today. Is that, James, to what extent can you sort of maybe clarify to the audience the extent to which debt investors have rights or influence, as it were, from the legal context, maybe?
Sure. I think, clearly the rights of bondholders vis-a-vis the rights of equity holders are very different. We'll go into the details as this panel develops, but in a very broad sense, I think in terms of bondholder engagement with issuers, you want to see it as two separate things. You've got the rights of bondholders and you've got the obligations of the issuers. And that's what we'll be focusing on here, and really that's what I think anybody seeking to engage with bond issuers should be focused on. What are your rights as a bondholder? And they're usually contractual, and they're set out in the terms and conditions of your bonds and the instrument that constitutes those bonds. What are the obligations of the issuer that you're engaging with? Well, they're twofold. They are contractual too, because they've delineated those in the terms of their bonds, but also they have regulations that apply to them. And so it's important to understand both what they've written in your contract that they say that they will provide to you, and also what you happen to know applies to them by dint of them being a debt issuer. So that's a good sort of dichotomy to keep in mind when we think about legal principles.
Okay, thank you very much. And maybe, Marayka, if I could come to you, is that to what extent when you're sort of thinking about investing and engaging, did you actually think about your legal rights fundamentally? Sure. Does it act as a barrier towards you actually wanting to do something? Because you said obviously that's what you focus on in terms of the debt side.
Yeah, sure. Look, with all due respect to the legal process, and a lot of work goes into those legal documents, and I'm a former lawyer myself, but when we're engaging, we basically ignore what legal rights are given to us in the documents and pick up the phone and try to engage anyway. We tend to come at our engagement program from a position of stewardship. So a lot of the money we're managing is for pension funds, and what we're finding is a lot of our end investors are becoming very interested in the legacy that their investments are creating. Obviously, as an investment manager, we're also interested in capital preservation, in risk management, and in enhancing our investment returns. But primarily, we're looking at this from a perspective of stewardship and whether we have the sort of legal right under the documents to engage with a company or not. We tend to ignore that.
Okay, that's interesting. And actually, I'm really glad Marayka's brought up the point of stewardship, because for me, I think this is quite fundamental. I often hear it being referenced in regards to equities, but rarely in fixed income. And I think to reiterate that point, that it really matters to us as well, is really important on that side. Maybe moving on to the next question that I've got is that I'm quite curious as to how other houses organise how they approach ESG engagement. So here at BlueBay, our model is very much that we have an in-house dedicated ESG resource team. I'm part of a team of 3, but ultimately our model is for our investment teams to actually lead, because we think as risk takers they are best placed. But I just wanted to get a sense to what other houses operate and how they think about it. So maybe, Mariska, I was quite interested, you said earlier that you've obviously got an equity component to what you do and a fixed income component to what you do, and whether you manage those differently in terms of organisationally and operationally. Who does the ESG engagement?
Well, within credits, it's very much a bottom-up approach. We have every analyst covers several names and knows the names individually, and they are the ones that are the best able to flag whether or not certain risks become material or not and should be dived into. So that's very much of a bottom-up approach at credits. If indeed an analyst sees certain things happening or risk evolving, informs the RIG team, the responsible investment and governance team, and flags his concerns. But the analysts themselves, they are in the lead. They are usually the one that pick up the phone and talk with the companies. If things become really a more multi-issue or a more bigger thing, then it could be more helpful to centralize the approach. Within equities, it's organized differently. The RIG department is in charge of the engagement process. It's also because there are much more names to cover, so it's much more spread, and there we focus on certain core themes like human rights, climate, and I have to check it out. Sorry for having it up. Remuneration. That's really interesting. As a bondholder, I'm less concerned with that than for equity investors, but I will explain later on. So so for equities, we're much more focused, and then it's from a centralized approach from RIG.
Okay. So, I mean, maybe, Alex, you can come in and sort of what is the PIMCO model? To what degree do you think we have to be structured differently in fixed income? Are there some structural reasons?
There's a big leap between integration and actually once you start zooming in from perspective of ESG dedicated products. And this is the journey that we went through. So from fundamental perspective, our analysts engage with companies. And just to give you some numbers, on a quarterly basis, PIMCO has about between 800 to 1,000 trailing one-on-ones with CFOs, CEOs, and treasurers. That does not count competitors in a room or conferences. So that's an hour-long meetings usually. Now, it's naive to assume that all of those meetings are purely dedicated to ESG. ESG issues are fungible in that. What occurred to us in the last 2 years is that to promote ESG, and more importantly to focus on impact as well, we need a dedicated ESG protocol. And we've hired resources. In fact, one of them is in the room, and we've hired from French banks with extensive experience on equities, so we're borrowing from the best practice, Niamh Hooley, and the ESG research analyst develops a dedicated protocol between 45 to 60 questions that are served to all companies in our portfolios. Now this is where we combined the access of our analysts, leverage the access that we have to companies, but also focus explicitly on ESG-only questions. And just to wrap up on this, the reception, to break the myth that the bondholders don't matter, the reception is great so far. We've received answers from most companies. What I mean is, out of 120, 118 responded eagerly. And personally, as a trader, I enjoy the element of surprise. A, PIMCO cares, and B, why do you care? And C, what happens to us if we don't respond? So, as bondholders, we're in a bit of a honeymoon season where the response rate is actually quite high.
Okay, that's really encouraging. Thank you. Maybe moving on to the next topic, because we've got a lot to cover, and I just want to, like I said, give you a taster, is that to focus the next few questions on materiality, because obviously this is a really important area for us in the industry. In other asset classes, it's come obviously from equities, where we're using it because we've got a business case rationale to looking at ESG, is to focus on what's business material. And a lot of efforts have gone into trying to define that, as it were. Given we've got a legal expert in the room, I was just wondering whether James has got any insight on this area in terms of, from a legal perspective, how do you define materiality, or how should we be thinking about it from that context?
Well, I think that focusing just on the the law of bond issuance is materiality as a as a legal consideration is relevant in two parts of the issuance cycle. The first is at the time of issuance, and then you look at materiality on an ongoing basis throughout the lifetime of the bond. And what I'm talking about here is materiality of information to be disclosed to issuers. The EU Prospectus Directive essentially governs that disclosure that the issuer has to give to bondholders at the time of issuance. And that's a one-off disclosure exercise to produce the prospectus. The issuer is then under a continued obligation to ensure that the market is updated with any material information. So really, there are practices that have developed in quite mature ways within both companies issuing bonds and investors holding them. But materiality for us as lawyers is really to focus on those two aspects and understand exactly at what point information needs to be disclosed. It's important to remember that's always going to be the decision of the directors of the company. And to the extent that an investor believes something is material and the board of directors of the company think it isn't, that's an interesting position to be in. But there has to be that recognition that to compel a director to agree that something is material is probably quite difficult.
Okay, that's interesting in terms of being tied to regulation on that side, rather than, like you said, the rest of it's then subjective in terms of what the directors think is appropriate. Now, maybe turning to my investor panellists, I'd like to sort of get a sense for to what extent are you preoccupied at trying to define what's material? And maybe in your experience as well, to what extent do you think materiality is sort of a stable concept? I'm just thinking in equities, generally you have one share class, so you have one sort of fundamental credit risk profile necessarily, and so the materiality of ESG issues tends to be a bit more stable across issuers. But what I'm finding in fixed income is that because you've got a single issuer with multiple issuance types in terms of the bonds that they issue, what you end up with is multiple credit risk profiles. And actually, because of that, so, the fluidity of some of the materiality of ESG risks actually vary. So I'm just wondering to what extent, and that's something that comes across maybe, Mariska, again. I just think it's really interesting that your position you have from the equity and sort of fixed income. Can you sort of comment whether that's something you're finding as well?
Well, actually, I also have to refer to our pension member beneficiaries, because actually, what's not material for us, that can be very material for them. Because if you see millions every day, you get a bit spoiled and lose a bit the anchors. So I have to be cautious in defining what's materiality. Well, what's important for me from a credit perspective is, of course, well, where are you in the capital structure? Is there an aggressive financing, or is it a conservatively financed entity with a lot of, other capital providers in front of you who can take the first hit rather than we? And you already mentioned horizon or maturity date. Well, of course, a bond has a specific maturity date, but we are more of a buy and maintain investor and also want to reinvest. So then you could say, well, your horizon is as long as your maturity date, but that's a bit short-sighted in my view, because you also want to refinance. Mm-hmm. So I want to come clear with that one. And of course, you also have to bear in mind, well, of course, if it's material for a bondholder, because you have a bit of a buffer in terms of assets which you can liquidate, or cash, or other capital providers who are subordinated to you. But you have to keep a balancing act between all stakeholders, of course, because in the end, if things go sour, you also need the more risky capital providers in order to come out and come clean with that. So there has to be a clear balance between those stakeholders.
Multi-dimensional, as it were.
It is,
on that side.
Not one definition of materiality.
So, Alex, do you have any thoughts on that you'd like to add?
Yeah, just very quickly, because I want to echo some of the comments in the previous panel. For us, it's about probability and severity of loss. Okay, so PIMCO developed the ESG scoring, which carries different weights on ESG depending on industry, and this is frequently revised. But what I also wanted to address in the question of materiality, specifically when comparing equities and fixed income, we tend to all fall into this easy to deliver equity-only view of the entire world, including fixed income. But there are some key differences how materiality presents itself from ESG perspective in fixed income. And I just mentioned 3 of them. First one is it's really a duration mismatch. As bondholders, we are obsessed about looking at the world as if it was one bond. And let's look at the equity if it's a bond, and the difference then between equity and a bond is one is 100 years of duration and another one is 7. So the way the losses manifest themselves, A, the time frame is different, but 2, if you have an ESG event, that what tends to happen is the shock is net present valued into today over 100 years of duration. This is why it's so more severe in equities versus the bonds. The second is really, which is not often thought about, is a subordination premium. In equity, it's a binary instrument. You either buy or sell, and it's one. In bondholders are present to a very complex capital structure, and the severity on the senior secured part of the capital structure that differs much to subordinated part of the capital structure. So one would argue, and we would argue, that in fixed income space, we can deliver similar and sometimes superior alpha because of our ability to extract liquidity premium associated to ESG risks. And the last one is obviously the nature of how they traded. One is a listed instrument, as one is over the counter, which adds to the complexity of bonds. They issued in different currencies, in different jurisdictions, in different structures. So to those that is impediment, we actually like that particular feature because from PIMCO perspective, this is where we add value by helping our investors navigate to the cheapest to deliver.
I think that's really helpful in terms of, I think we wanted to make sure as a panel to help you sort of bring out in terms of the nuances of the asset class, because I think it's very easy to generalise, and actually it's very, very important to make sure that you break it up into the sub-asset classes and understand within that the different issuer types, the different instrument types that carries different risks. Maybe sticking with materiality, but thinking in terms of what's material in terms of E, S and G, is that I think not surprisingly you're getting the message as with equities that G is the most important issue, and we would certainly agree with that, because fundamentally for debt issuers we have to have confidence in the ability and willingness of the debt issuers to actually meet their debt obligations. But I think, Mariska, you alluded it to earlier on, so maybe I'll come back to you, is that what I would sort of agree with you is that we are probably interested in different G issues to equity investors. Would you like to sort of allude on that a bit?
Yeah, the differences, well, they're also of course common things, because actually the main differences that I see from between credits and bonds, or fixed income and between credits and equity is possibly to shareholder concentration, which is often regarded as negative for equities because minority shareholders are not heard. While as a fixed income investor, I'm usually pretty happy with a stable and a big shareholder who has a very consistent strategy and is predictable. So there you can have a different view on shareholder concentration, whether or not it's positive or not. And also participation of activist shareholders into the capital structure. Equities investors like them to shake up things and get more structured. And for bondholders, it's a lot of event risk popping up. Look at Heinz Kraft and Unilever. Everyone was afraid, oh my God, what's going to happen? And there's also 3G behind it. So that's a lot of event risk that involves there. And also, I mentioned it earlier about remuneration. As a bondholder, I'm less concerned in remuneration unless it provokes excessive risk taking, of course, that it really jeopardizes the risk profile of a company. But I wouldn't mind, because actually most remuneration is of course tied to stock options. Well, maybe you should tie a part of it to CDS or bond type instruments in order to provoke an incentive for management to also consider bondholder interests.
Yeah, well, that's really interesting actually, like you said, making it a bit more explicit. Maybe coming to you, Marayka, is that to what extent, maybe moving away from the G, can you give the audience a sense for you looking at the E and the S issues, how you look at that?
Sure. I think, as you've said, governance is fairly well understood in fixed income space. What we're seeing from our end investors is a lot more interest in E. Okay. Certainly sort of climate change is very topical in our region. We're fairly well known for being dependent on agriculture and resources. So you see sort of a lot of the superannuants, the millennial group, very interested in, you know, the environmental risks of their superannuation. A lot of children of pensioners, you know, coming home from school, very sort of interested in climate change. I think the other thing that's quite topical in the region is we're seeing a lot of sort of information requirements and a lot of talk around diversity on boards, diversity in organisations as well.
That's really helpful. So that's, I probably will wrap up there because I'm just conscious of time in terms of the first part of our panel discussion, which is a bit more about the whys, as it were. Before we move on to the second part, which is a bit more practical in terms of the hows, and so our panellists giving you some insights into how they try to maximise success, is let's try and do the last of our poll. So again, I'll just read out the questions and when I'll read out the options, and then we'll do a show of hands in terms of what there is. Now with this one, it's not just one choice. You can put your hands up as many times as you'd like in relation to whether this applies to you. So our third and final question is, what types of debt issuers do you engage with? So the options, I'll run through them first. So they've got corporates, IG, so investment grade, corporates high yield, corporates emerging markets / state-owned enterprises, municipals, sovereigns developed markets, sovereigns emerging markets, and then not applicable, again, the last catch-all. So I'm going to run through it now, and if you'd like to sort of do a show of hands where this relates to you. So are you involved in engaging with investment-grade corporates? Okay, that's not bad. And sort of high-yield corporates? Okay, and then in terms of engaging with emerging markets / state-owned enterprises at all? Brave, very brave. Municipals? Oh, okay, and then sovereign developed markets? And then sovereigns emerging markets? Oh, okay, very clear division there, I think, on us. Interesting. And then the last group, I guess, in terms of those where it's not applicable, I think we saw it was about a third of the room, wasn't it, earlier, as it were? Okay, that's interesting. We'll come back to that, actually, because what you've got there touches on some of the points that I'd like to raise with the panel. So we heard earlier how we as investors have different legal rights, maybe less legal rights because we're not owners, but we do have them. So how do we try and overcome these structural legal issues? What do we do to try and maximise success? So here maybe I'll pick on sort of Alex, as it were, in terms of what tips can he give us in terms of how PIMCO's found, in terms of what are some of your strategies for maximising success on bondholder engagement? Okay,
so structurally first, the bondholders matter, and they not only matter because of the legal rush, but the profitability of large investment grade space is largely predicated on low cost of funding, and we happen to be the one that provides that. So from this perspective, structurally, there is a backdrop against which bondholder engagement is not only an option, but actually a responsibility. The second thing, it's very important not to brand every company of not wanting to do the right thing. Mm-hmm. For us, we tend to make a distinction between those that are able and those that are willing. No point asking a coal company to divest from coal, it's going to drown their business. There's plenty of point to ask an integrated oil company to invest in renewable because they have the financial ability to do so. So we developed this approach, three-pronged approach, which is called Think Like a Treasurer. And under that, we put ourselves in the shoes of the treasurers and see if they can afford the ask. Two is Engage Like a Partner, is to unlock the willing. You can have companies in integrated oil space that have the ability, all of them have the ability to change, and some of them will be more willing than others, and differentiation here matters. And the third, final stage for us, it's all about integrity, and that is hold to account as a lender. Because while the first two stories might be fantastic, what we're promoting with the third one is don't drink your own Kool-Aid, but keep people to account. Hold people to account as to how they're delivering those targets. And obviously wrapping the framework, reportable framework around this, which we can show transparency to our investors about all the three areas. Mm-hmm.
I like that. I'm going to steal that. I've written it down here.
I think we all are.
Think like a treasurer, engage like a partner, and hold to account like a lender. I think that's very catchy.
So to the
I
extent
haven't trademarked that.
and it kind of is, SASB just published this under the same, we submitted our case study to SASB.
Okay, thank you. That's really helpful. Maybe I can actually bring in James here because I'm quite interested. He alluded earlier when he was talking about investor and debt investor influence, and he talked about through the issuance cycle. I wonder whether that's something, an area we should bear in mind a bit more as debt investors in terms of being a bit more strategic in terms of the timing of our engagement to be successful. James, would you like to sort of expand on that a bit more, please?
Yeah, sure. Yes, it's a very important strategic point, really, the timing of engagement. And broadly, you can divide it to pre-issuance and post-issuance. Pre-issuance engagement will always be most effective where you're in a private placement environment because you will have direct negotiations with the issuer, and that would probably be the best opportunity to get, for example, an ESG-related covenant into the bonds. However, that will never be a very easy thing to do because any breach of covenant clearly leads to events of default, and therefore there will be strong resistance to anything that's not easily measurable or objectively definable. Clearly, you're not a bondholder at that pre-issuance point, you're a prospective investor, and it's important to keep that in one's mind. When in a non-private placement scenario, engagement will be less direct. It could be through dealers and underwriters, and it could even be as limited as just expressing a reason why a particular investor didn't subscribe for bonds in that instance. There is an awful lot more in a pre-issuance, non-private placement context that one can do engagement-wise. Post-issuance, a lot of your rights are contractual. The distinction between private placement and non-private placement becomes less relevant. And typically your contractual rights tend to be rights to information by the issuer, rights to inspect documents. Certainly under English law, trust deed, corporate bonds, bondholders have the right to convene meetings if they hold over 10% of that particular principal issuance. And so that can be a useful tool. Typically it's used for passing extraordinary resolutions, but there's no prohibition on, or no prescription on what in fact has to happen at those bondholder meetings. So that could be another tool just to bring an issue around the table to discuss issues. One last point, companies frequently need to refinance and often modify the terms of their issuance. That's a point at which post-issuance bondholders have the ability again to have robust dialogue with their issuers. It'll always have to be borne in mind, however, that the focus is going to be economic there. To the extent that the company wishes to refinance its debt, it's going to be focusing less on ESG perhaps, but more on the economics. However, that's not to say that bondholders who have to decide whether to agree to the new modified terms or not can't say, well, one of our stipulations is that you do the following. So the life cycle is very important, and the timing and who you are at what particular time can certainly aid engagement.
Okay, I think that's really, I mean, for me, that's been one of the key sort of light bulb moments for me, I think, in working as part of the working group, is this sort of legal perspective on this in terms of being very valuable in terms of how we can sort of maximise our success. In terms of, maybe my next question sort of touches a little bit on the poll that we just had, looking at who you've been engaging with, whether that could be a component in terms of maximising success in terms of the type of issuers. Maybe, Marayka, I can bring you in at this stage to what extent do you think there is potential sort of, it's more fruitful to invest in, to engage with certain types of issuers, maybe? Do you think that that's the case?
I certainly think James has covered it off well, but if we think about high yield space, and we're not doing a lot in high yield at the moment, mainly from a returns expectation perspective. But we used to do a lot in leveraged loan space, and if I think back to the process there in the leveraged loan deals, there was a much longer lead time than we're finding in investment grade deals. And as James has alluded to, there's a lot more opportunity to influence the documentation of the deals. And so that in theory, that's the point when you can start to ask for information to be included in document reporting requirements, that sort of thing. I think Alex has a bit of a view here as well, but certainly, what we do find in high yield space, though, is the issuers are a lot less regular in coming to market. So, that lead time, when you're sort of pre-deal, that's your chance to really influence, but they sort of do tend to love you and leave you.
I think that's right, actually, and it's funny for a broader audience. We've discussed it prior to that as well. I actually agree with the leverage loan point because of the private lend and the lead time. However, the low interest rate environment for long had invited quite a lot of public high yield issuance, and I think from our perspective, it's worth breaking a myth that bondholders should matter a lot in high yield, and by high yield I define it as public high yield, public liquid high yield. Now, we find it quite the opposite. In investment grade, we have quite a sway and a leverage. Like I said before, they depend on low cost of funding. With high yield, what tends to happen, structurally, they're levered companies that have much lower flexibility to start with to implement any changes past the issuance. The second point is, from our experiences, high yield companies tend to be smaller, and once they borrow, they tend to go into quote-unquote hiding. It's a lot difficult to actually get hold of management, despite of the size of institution that we are. That's more structural comment. Tactically, of course, it's different. Now, there's also another myth that when high-yield companies are in trouble, then the bondholders should matter. Of course, they should, but they don't. And the reason for that is when high-yield companies is still kicking, i.e. going concern, but is in trouble, they tend to have all hands on deck and start resolving for the private equity owners. So the disclosure is even poorer as if it was from the beginning. Now, where the bondholders really matter is when the company is defaulted and we've been given the keys. And even then we have to fight for the keys in the recovery. So from the perspective of affecting change and affecting outcomes, we find that structurally high yield, listed high yield, rather than private high yield like levered loans, is a lot more challenging. Now, I'll introduce one last thing to this, and this is a timeline. It just fundamentally changes the way you construct a portfolio, an ESG portfolio, an investment grade versus high yield. In investment grade, you could put together a diversified portfolio which you then able to change. In high yield, you're down to choices that you make from the start, knowing that the companies are very unlikely to change later on. And that obviously changes. Today, it could be less attractive, but as we go through the cycle, and we'll see a number of falling stars, falling angels, those are companies from investment grade with investment grade listening that could present a good opportunity to build a high yield portfolio.
I think that's a really important point we'd like to sort of leave you with, in terms of there are pros and cons and theories to the different sort of issuer types in terms of high yield investment grade. I would probably throw in another category, which is corporate financials. I think potentially you might be more fruitful with those than corporate non-financials, but again, because of the point that they have to cut, they're often very repeat issuers to the market, and so they want to have that stable investor base, so potentially. So thinking about it in that way might be helpful as well. I'm just conscious of time, in that maybe my last sort of question before I open it up to questions for you and the audience is to touch on strategies to maximise success in terms of collaboration. So obviously this is something the PRI has really championed and been so pivotal in terms of driving forward on the equity side, but we've not really seen much happening on the debt side. So I guess my questions to the panellists are, to what extent do we think the nature of the fixed income world, there is a structural barrier to us collaborating, or there isn't, or what are the barriers that we need to overcome? Maybe Mariska, would you like to comment?
Well, first of all, there's quite a practical barrier. It's much more difficult to get to know the bondholders of a company than the stockholders which are registered. So that's just a practical but a very important hurdle, I believe. And also, we have to get on the radar screen of the companies themselves, because most of the work is focused on the share price and shareholders. And it's not that they're not willing, but I mean, we're just not on the radar screen. So they should also be more aware of inviting us as well at specific events which cover broad topics like strategy. So get on their radar screen. And earlier I also mentioned, maybe the remuneration should be tied to other things than stock options. And it's also, last but not least, bondholders themselves are also very much a homogeneous group. And we don't always agree with each other risk appetite we found acceptable. We have different horizons. It's not easy to transfer risk. Liquidity is an issue. So we are also ourselves to blame that collaboration is not that big.
Marayka, I mean, what's your thoughts in terms of the scope to which we as investors could do more collaborative engagement on debt investing?
Well, I'd point you to, if you haven't come across it before, the PRI collaboration platform. We, on the working group, had a look at it recently, and it's a really excellent tool that I think we'll, as our own organisation, will get more involved with. It doesn't discriminate between fixed income and equity holders, and it doesn't discriminate between your size of holding at all. But if I can think about collaboration more broadly and sort of introduce the Australian perspective, obviously the market, the bond market, there's a lot smaller than the US or the European market. We all tend to know each other fairly well. And one of the things that's happened quite sort of organically as far as collaboration goes there is if there's a deal where there's terms in the deal that probably aren't bondholder friendly, or if there's a deal that's going south a bit, a call goes out in the Aussie market, you know, do you hold these bonds? Are you looking at this deal? And bondholders tend to get together and form a bit of a negotiation block. And we've done that a number of times outside of the bank market. We've just gone directly to the companies as one block. And that's been very effective in sort of enforcing bondholder rights and showing the companies that, you know, we are interested and we're an important part of the capital structure. And, you know, if we ignore the size of holdings and that sort of thing, I can't see why a collaboration network like that can't sort of work well alongside of your own sort of idiosyncratic engagement programs.
Okay, thank you. I've got loads more questions here, but I'm just conscious of time, so I'm going to sort of free up the time now in terms of you as the audience asking some questions. So, I mean, how we'll do it is I'll take 2 questions at a time, and maybe if there'll be a mic going around, so if you are chosen, please can you sort of state your name, your organisation, and very, very briefly ask your question, and then we'll find out who from the panellists can answer those for you. So if you'd like to show of hands, please. Yep, go for it.
Hi, Lisa Wade from National Australia Bank. This question's probably for Alex, but I'm happy for anyone to answer it. If we talk about, well, I do want to change the tack a little bit to social bonds. And if we talk about the SDGs and trying to make them investable, then we have to start talking about thematic and social bonds. And I'm just wondering how you see the constraints around portfolio construction, because often the social bonds have to be structured very differently. I'll use the gender bond that we did as an example. That was very easy to put away because it was facing off against the NAB balance sheet. Yet we have a little SDG number 8 social bond at the moment that's very tiny, and we're struggling to communicate that to investors because the structuring is very different. I'm wondering how you guys are thinking about that in terms of portfolio construction and what we need to do to build that capacity.
Thank you very much. I'll just take one more question if I can, Alex. Can I just have another one? Okay.
Hi, my name is Chris Hackle. I work in the Bloomberg Barclays Fixed Income Index Group. My question is for the organizations that create ESG ratings, Sustainalytics, MSCI, etc. Do you guys feel that those evaluations are equally applicable in equities as they are in fixed income? And I guess, Alex, since you guys have your own ESG evaluation, was that designed specifically for fixed income?
Okay, thank you very much. Right, so we've got 2 questions there. One in terms of the impact of social bonds on portfolio construction, and one in terms of the relevance of the analysis that's coming through from the providers in terms of being credit relevant on ESG. So maybe, just in the interest of time so we can get some more questions, maybe one response to each of those from one of you, if that's okay. Alex, there was one addressed specifically to you. Would you like to take that?
Okay, so the social bond conversation, I think the starting point should be changing conversation altogether, which we've done. We don't look at green bonds as green bonds. They pari passu issuers with additional disclosure that otherwise would not be available. And as such, we looked at all of the bonds delivering change as impact bonds. So from our perspective, social, green, and others all fall into category of SDG bonds. And once we start targeting SDG bonds, then all the complexities becomes almost not complexities, but help to delivering it. If we change the pivot and start looking independently at green, independently at social, it becomes a very confusing game and difficult to create a market standard. Creating a standard around SDGs is a lot simpler, because by the nature of SDGs, you can measure impact as well, which I think is what the market wants.
Okay, now who would like to take the questions on the research providers?
I can do. Well, actually, we indeed the research ESG research providers, they really from an equity perspective, and it's they're clear. We see clear differences. I already mentioned some differences from the part of governance, where they really take a different view than we as bondholders. So how we solve this discrepancy within MN is that, the analyst, the credit analyst is, we take the third party as an input factor, but the analyst himself is responsible for the ESG paragraph, and they have the ability to say, well, the provider says A, but we disagree because of this reason. But you have to, you have to really provide arguments for that, because there are clearly differences between the two perspectives, which needs to be addressed.
Thank you. I'd agree with that as well. I think the panel would. Can I take another two set of questions, if I may? Okay, Carmen's just coming up. I think we've got two in the front here.
Oh, hi, it's Bruce Stupid from Hermes. Be interested to know what sort of conflicts of interest there can be when engaging with companies on credit and also on equity. To what extent are they aligned to their interests, and when are there definitely conflicts, either in the short term or over the long term?
Okay, thank you. Next one, Peter.
Thank you. Peter Michaelis from Lion Trust. Just wondering if the panel could give specific examples of a time where your CIO has said thank the Lord for having an ESG department because we missed that bond and went wrong, or an example of where you managed to get extra disclosure where you wouldn't have otherwise.
Thank you very much. Right, so the first question about conflicts of interest between equity owners and fixed income investors. Who would like to take a stab at that? Do you want?
Well, don't always want to be first.
James, would you like to come in from a legal perspective? Do you think there are any conflicts of interest?
I think, just from a legal perspective, we looked at bondholder collaboration, specifically. Are there any concerns with bondholders getting together? So this is slightly different to the bondholder equity holder point, but on the whole, that type of collaboration which seeks to engage issuers, as part of a collaborative approach, doesn't seem to have a problem. There are certain concerns where bonds are asking, the issuers are asking bondholders to agree to something, and then those bondholders collaborate in order to affect pricing. In terms of the same institution holding both equity and bondholders, it's certainly something that needs to be addressed internally within that institution to ensure that there is compliance with, for example, all insider information regulations.
Yeah. And maybe I can answer that a bit in that I think you see it in the situation maybe where the management is has their risk appetite in terms of the risk profile. Maybe from an equity perspective, you may want them to be more aggressive in some of the risks investments that they might make. Whereas from the debt side, we actually want to make sure that they're not taking on too much debt, too levered, because that could put stress on the balance sheet. So I think in situations like that, where I think in terms of corporate strategy and the risk appetite is probably one of the most acute that I think contrasts where we might come in. But like you said, there's conflicts of interest between us as debt investors, you'll see, in terms of where we fit in the capital structure as well. So,
well, and the clear one is debt finance big shareholder distributions. That's, of course, a big conflict of interest between the two.
Okay.
A very obvious one.
So maybe on Peter's point about the case studies, the holy grail of examples to demonstrate that actually ESGs add value.
Can I take that?
You sound like you want to, yeah?
Yeah, I kind of do, because my CIO happens to be in the room, and we co-manage the ESG dedicated accounts, and the integration for PIMCO is championing the ESG integration. I'm not sure, Scott, if you said thank you for avoiding ESG debacle, but he's definitely said thank you for building ESG platform.
Brilliant. Okay, I'm just conscious of time that we're on. If you don't mind, I'll just take an extra 5 minutes if I can, just to wrap up. But actually, I'd noticed earlier that we've got quite a lot of debt investors in the room and non-investors. Are there any corporate issuers in the room? Yeah, and then maybe could I ask you maybe to throw the question at us in terms of to what extent can you share with us your experience about engaging with investors, whether we're debt investors or equity investors on ESG? What has been your observation about what we're asking, and maybe do you have any tips for us about how we should be engaging with you? So I think we've got one there.
I'm Calvin Kwan with Link Real Estate Investment Trust over in Hong Kong. I guess we issued our first green bond about a year ago, and in the end about 95-96% ended up going to Asian investors. One of the challenges that we felt and faced was that the Asian investors didn't really look at our ESG. It was mainly on credit rating. Now with One Belt, One Road taking place in Asia, Southeast Asia having a lot of infrastructure projects that should qualify for green bonds, I'd like to, I guess, ask a question out there. How do we educate the debt investors over in Asia to be a little bit more proactive and engage with us on some of these discussions? So, for us, when we went through, none of our debt investors asked us questions on what we would be reporting on. They read our green bond framework, said it was okay. Nobody had comments, so there wasn't any way to improve upon it. Is there something that you guys would recommend on how we would reach out to you? My only advice would be to, for the investors, actually what you guys said, to ask us questions and have that dialogue.
Okay, thank you very much. Right, I think I'm going to have to draw this to a close, because otherwise we're going to keep you from your coffee break, and I wouldn't want to do that. So maybe quickly wrapping up is that, can I ask our panellists to maybe leave you with one top tip that they would give you in terms of if you want to start or you want to improve the effectiveness of your engagement, what would that be? Maybe I'll start from far.
Yeah. Well, I feel a bit of reluctance of engaging because one feels that there's no real influence or legal impact. But I think that's a bit of a worry, because actually if you start engagement soon, you will probably never need this influence. So be proactive, I would say.
Okay. James, I'll come to you at the end if I may. So Alex, top tip?
Yeah, so for us it's build on your strength. If you're a large asset manager, goes in size and go quickly. And if you're small, offer issuers something that they don't have, and this is your expertise. And if you're moving a tanker, if it's a structural change, engage in collaboratively in groups and affect the industry. But also be mindful of your limitation. For us, engagement is very financial in value. It unlocks future value, so contributes to the future returns.
Marayka?
I think, as a bondholder, remember that you're an important part of the capital structure for a company. The lenders above you and the shareholders below you are demanding a lot of information requirements from companies, and there's absolutely no reason why you can't too. I think we find that when we pick up the phone, companies really want to tell us about their ESG practices, and they want to learn from us what they're seeing from other organisations, what we're seeing from other organisations as well. And certainly if we encounter resistance from a company to engage with us, that feeds into our credit view on the company.
Okay, then maybe very quickly from my side is maybe not a tip, but two asks for two stakeholder groups, and actually one of them's come up in one of the audience questions, is that my plea to the sort of the debt issuers out there is that we need more sort of public ESG information. It's really important. We're getting to a good level on the equity side, but on the debt side we're nowhere near there. So to really to make sure they've got quality, consistent disclosure so that we can benchmark them, as it were, and for them to proactively engage with us. Calvin, your point there, you're dying to engage with us and you can't find anybody to engage with you on. And from our side, we're struggling to find the companies to do this proactively, so there must be a middle ground somewhere, and maybe that's where the role of the PRI can come in as well. And then the other plea is linked to the question earlier about the research providers and the credit rating agencies and the sell-side brokerage community, is that we desperately need credit-relevant ESG analysis. It is right that the bulk of what we have out there is equity focused, and it doesn't really help when I'm trying to talk internally to my credit analysts when the research is more of an equity story. So I think that's really important. In terms of trying to wrap up, gosh, where do I start? Hopefully we've set out very clearly the whys we should be engaging on this, and we've resolved, hopefully for you, that we do have influence and we do have the responsibility and a business case to engage. Yes, we're structurally challenged, but there are ways to overcome that. We just need to be a bit smarter and be a bit more organised and a bit more strategic, and the impact that we can have will be hugely significant given the size of the asset class and the scale of the challenge that we have. Now, before I let you go, is come back again to the webinar that I mentioned earlier on the 2nd of November. You can register on the conference app for the discussion paper, and there'll be 7 practical case studies. So please, please, please look out for that. And then lastly, in terms of practical logistics, I understand you've now got a coffee break, and then at 3:30 you've got the plenary session. So I think all that's left for me is to really sort of say thank you very much to our panellists who've been hugely generous with their time and insights. And then just to thank you as the audience for coming along. Thank you.
That was fun.